Are U.S. stocks priced for perfection? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Sam Rines, macro strategist with Wisdom Tree. Hi, Sam. It's great to have you on the show.
Oh, always a pleasure to be with you, Maggie.
So we haven't spoken in a little while, and gosh, there's a ton going on the macro front. Today seems like everyone's getting a chance to catch their breath a little bit this week. Stocks continue to grind higher. The dollar and crypto also pretty much hanging on to their gains. That 10-year hovering around 4.45%. With a CPI number that was pretty much in line with expectations, so it kind of gave everyone a chance to sit back a little bit. But let's start with that, since inflation seems like it's on everyone's minds these days. What's your outlook for inflation? How'd you feel about the number?
Yeah, so it was in line. It wasn't a surprise. That was actually kind of nice, right? We all got to, exactly like you said, take a breather, relax a little bit, get to digest the data instead of reacting one way or the other with some sort of either uh, ebullient or apocalyptic kind of rhetoric. And that's been, that was kind of nice, right? You just kind of got to sit back and actually go through the data without having to really be uh, overreacting either way. When I really dug into it, it looked a little stickier than I would have liked. It wasn't exactly what I would have preferred for the underlying dynamics. Goods continue to be in a deflationary kind of environment. Food away from home. When we go out to restaurants, that was sitting at a little under 4, but it's still a little high, a little hot. Auto insurance was unexpectedly down. That's probably going to rebound a little bit, and remains pretty sticky. And housing and shelter remain problematic. But even stripping out housing and shelter and just looking at the underlying services inflation, that picked up a little bit and was somewhat of kind of like an eyebrow raise of, if we do continue to have an economy that produces jobs, produces wages, potentially, has avoided recession and will continue to avoid recession, all of a sudden you kind of say, ooh, are we going to get all the cuts that are priced in here? Maybe we don't quite get all of that. So to me, it was a little bit of a mixed bag. It was pretty positive for anyone looking out the next 6 months for Fed policy. But beyond that, I think the market did a pretty good job of, higher long-term rates today. Call it the 7-year out to 30-year was higher on the rates front, and anything under that was lower. So I do think that was a pretty interesting move, but it was also probably the right pricing in of the current inflationary dynamics.
Yeah, I guess we've kind of become conditioned that, boy, if it doesn't shock the pants off you, then it's kind of like, oh, it's kind of relatively an expectation. So I guess that's okay. But it needs to be moving a little bit lower, doesn't it? It seems like the bond market is. Talk to me about the bond performance versus other assets, because we've seen this, real optimism and rally happening in stocks, but the bond market seems concerned, and we've seen those yields moving higher. That seems like it's something to watch or problematic. How are you thinking about that rate environment, and then what it's going to mean for equities?
Yeah, so I don't think it matters as much to equities as we would typically think. Part of that is because growth is fine, right? Growth's fine, earnings are fine, margins are hanging in there. Revenues continue to do pretty well, so it's just not as big of a deal that it would typically be. We've already lived through a pretty elevated interest rate period, whether we're looking at housing, autos, whatever it might be. If you were going to get a significant interest rate effect, it would probably be in those categories. To a large extent, we've already seen it. Hasn't really weighed on the U.S. economy. So I think equity markets are kind of looking at it and going, whatever. And bond markets are really looking at a stronger growth environment, potentially, when you had the red sweep, regardless of what side of the aisle you sit on politically, when you have all of the all the two major branches of government that tend to be reactive and tend to be something that the equity market actually pays attention to in one political party, that tends to be, pretty good for the spending side of the equation, pretty good
Mhm.
for the policy side of the equation, getting things done. So I think the equity market is saying, let's buy the winners that we think are going to happen over the next 4 years. Let's, sell the losers. And, do we really want to be overweight fixed income when we think we're going to get better returns out of the equity market? So I don't think it's necessarily about inflation. I don't necessarily think it's about deficit spending. I think it's about you probably don't have a recession on the horizon. You probably have 2.5% growth and 2.5% inflation. So the 10-year, 30 years pretty well priced for that type of positive equity environment.
Yeah, so they can handle it. Sounds like people kind of think that, listen, if you've got a high growth economy, we can handle this kind of rate.
Exactly. We have handled this type of rate, right? That's kind of the critical part to me is the Fed's lowered the front end interest rates by 75 basis points. You've got the long end sitting at 4.5. That to me isn't the worst kind of interest rate environment. Now, if you have an 8% 10-year, that's a different story. If you have a 6%, FOMC Fed funds rate, then that's a different story. But we don't have that dynamic. We have a dynamic of pretty good growth, declining interest rates on the front end, and a long end that, has, rates have moved a little bit higher, but they haven't really gone out of control. So that's a pretty positive view for equities.
So we've seen this big rally in equities so far, this big sort of post-election rally. Does it feel like we can continue from here, or did we steal from some of the what would have been a seasonal year-end rally? How does the momentum feel here?
Momentum to me feels perfectly fine. I don't think we stole that much from the future, honestly. If you think about the potential for lower tax rates in the out years, whether some sort of bill gets passed in 25, whether it gets passed in 26, equity markets are going to discount that, and they're going to discount that pretty quickly. On the other side is, what's really going to knock this thing down, right? You
Mm.
had Meta report earnings of $6 plus a share when they were supposed to be reporting 525, took up their capex spending on data center chips, aka AI, aka NVIDIA, for 2025. Then you had Alphabet do the same thing. So to me, you've got the big names doing the big things, and they're telling you they're going to do it for the next year. And when companies tell you they're going to do things for the next, 18 months, that's a pretty big deal, right? You typically don't have capex spending numbers taken down when they're making returns on it. And Meta, Alphabet, Microsoft, Amazon, they're seeing the returns on AI. They're seeing the products begin to produce revenues, produce earnings. That's a pretty interesting environment for anyone that says, well, it's too expensive. Well, yeah, it's too expensive, but it can stay too expensive longer than you can stay short.
Wow, that's so interesting because I feel like there's this narrative, and it's always confusing because there are definitely camps, and I feel like before anything happened with the election, there was definitely a group of people who felt like the AI trend had overshot. Some of them go as far as bubble, but others, even if they believe in this sort of AI revolution, just felt like you'd hit a point where you'd had so many gains already, and then post the election, there's been a lot of talk that, you're going to see shifts in spending that favor the worker more at the expense of maybe these big technology companies. There are a lot of threads about how this is kind of over for technology. It sounds like you are not hearing that when you're looking at the details of the earnings.
Oh, no. And it's kind of interesting because a lot of that narrative is predicated on the idea that it's one or the other, right? That the policies are going to be all on the worker and therefore it's going to be bad for tech. And quite frankly, particularly with the large US names, that's kind of the wrong way to look at it. Where do Amazon, Meta, and Google get the vast majority of their revenues from? They get it from advertising. What's the number one advertiser in terms of a category on digital and social? Guess what? That's consumer packaged goods. That's your big consumer names. So as the consumer strengthens and as you continue to have, maybe worker friendly policies put in place that puts more money in their pockets, there's going to be a lot of companies trying to compete for the incremental dollar that's being put in workers' pockets. That's going to translate to advertising. That's going to translate into AI investment, and you get a positive feedback loop. So to me, the notion that there's this, we call it worker bias, is not necessarily bad, and probably is actually beneficial to big tech. You have to look at what the knock-on effects are, and that's not going to be a day one type thing, but it is going to be over the long run something that benefits big tech. And if big tech doesn't have, call it their big tax breaks for investments in AI data centers over the next, call it 4 years, they will figure out another way to maintain their current margins. They'll drop a lot of money to the bottom line, and I think it's going to be pretty shocking to people that when workers get more money in their pockets, it doesn't stay there. It tends to be spent, and it gets spent across a lot of the platforms that everybody's thinking are going to get left in the dust.
Yeah, this is right with when there's no recession. This is the typical situation, which we know. And American consumers, right? 3/4 of the economy is spending. So if the American consumer is doing well, then that makes a lot of sense. And that's an interesting way to look at it, because yes, I do think that, and I'm asking because I have people coming on the show saying that. And then on the flip side, I have the tech bulls, it goes back and forth. So it's an interesting tension. J&J has a question. Hi, everybody in the chat. It's great to see you, as always. J&J has a question. What other sectors does Sam see doing well and benefiting from a stronger consumer outside of tech and advertising?
Oddly, I think there's places to look at the intersection. So I don't like to look for kind of, call it a sector that's going to win on a singularity that may or may not be correct. So the places I like to look are, think of it as, where does AI benefit, and where's the benefit not being seen in stock prices, and maybe with a little bit of development. So one of the things I think is being overlooked, and you saw it in the Reddit quarter this time, is those LLMs, those data sets are incredibly valuable, and they're difficult to find. Some are really being overlooked here. One of my favorites, and I might have mentioned it last time I was on here, was Kroger. Like, Kroger has a giant data set of what American grocery consumers buy, when they buy it, and at what price they buy it at. They have all of that data. It's connected to phone numbers. It's connected to where you are by store. That is a very powerful data set that they can license and or use for advertising themselves. So to me, where I want to look now is for who has the data that is being overlooked, and who isn't getting the multiple that they deserve based on that. Because the number one thing that a lot of AI-based firms, a lot of companies that are currently valued at very high multiples are going to be looking for, they're going to be looking for data. Because you can build the technology all day long. If you don't have the data that tells you that I want to buy chicken this week and steak next week, it really doesn't matter. So to me, the interesting places to look right now are the under the radar, very interesting data set companies.
That's so interesting, Sam. And you all know this LLM, large language model, right? That feeds, that's what the AI learns on. So that feeds that your ability to do anything with it. And that's so interesting. In a way, it's sort of the next obvious, well, not obvious because a lot of people aren't talking about it, but logical play because hardware was first, right? The chips, but data is almost like a resource, like it's the gold that makes it all go. So it makes sense that if you're sitting on that data, and people tend to think that's the kind of the argument behind Tesla, right? Oh, well, it's really, and Elon bought Twitter just for the data, which, maybe, but you're looking at things that people might not think about, like a supermarket.
Well, it's worth remembering, GM is the first to bring robotaxi to market, right? I mean, they just announced it. And GM is, posting on their latest quarterly call, said, we're going to have a tailwind on the EV front of $2 to $4 billion next year. Like, that is a big number for General Motors. I mean, that would be a huge number for Tesla too, but that is a big number in a world where everybody's a little skeptical of whether or not the EVs are going to make money. GM actually has probably as much data as Tesla.
Really?
If not more. Yeah.
But we think Tesla has it because they have those computers in all the cars.
Yeah, so does GM. I mean, GM actually has a robotaxi business that's fully automated, that is completely out there. So it's one of those where it's a lot of narrative, and when you really dig into the numbers, there's some that are going to win, and there's some that are winning that aren't really getting the multiple that they probably should be.
Wow, that's so interesting. So we have a question. So just let me wrap up the AI a little bit, the AI conversation before we move on, because this is a completely different topic that we're getting asked about. So do you think that we're going to continue to see, or you're hearing and listening to the tidbits and all the earnings, that capex is going to continue? Does the AI in general revolution translate into gains across technology, mega cap, or does this start to get more nuanced and specific? Because one of the things was that in the early days, everyone was throwing AI out in their earnings call, and that was sort of good enough to generate enthusiasm. Does it get more discerning from here? Do people have to be more careful, or is a general bet on tech pretty good in a revolutionary time?
It gets more discerning over time, right? At some point, right, chips are cyclical. At some point, AI chips will be cyclical, and it will go from building out AI data centers to maintenance capex on those data centers, putting in whatever new chip might be on the margin, but not building whole new facilities. And so at some point there will be, call it a mini Cisco moment, where the orders don't stop, but they do slow. But that does not appear to be something to worry about in the next 3 to 6 months. It's more of something to worry about in 12 to 18.
Amazing. Okay, so Ralph in the chat wants to know, what is Samuel's, he's very formal today, what is Samuel's view on China?
Ooh,
that's just a giant question. I'll be a little bit more specific.
Yeah.
Are you hearing and you're so in the weeds, and you're so great about just being so in detail on so many different aspects of earnings and companies and what they're saying. What are you hearing companies say about China? Are we learning anything about the economic recovery from anyone who actually has boots on the ground there and is trying to do business?
Yeah, it's not good. So if you're Nike, you saw bad revenues, you saw bad operating environment. Starbucks, same thing. You saw it going down to something like an A.O. Smith or Otis elevator, right? A.O. Smith makes hot water heaters. Otis makes elevators. You saw pretty much every company with significant exposure to China that was announcing in the U.S. You saw pretty bad numbers out of China. Like, we're talking down double digits or high single digits at best in terms of revenue. That's pretty problematic, honestly. So it's great that that the Chinese are attempting to get their real estate issues under control. That's not enough to get the consumer back into business, right? Really, if you want to see the Chinese economy boom and you want to be able to invest there, you've got to see some sort of stimulus on the direct-to-consumer front. Otherwise, it's going to be a much, much more difficult operating environment. You're probably not going to see significant investment from many U.S. businesses, particularly following the election last week.
Mm.
It's a lose-lose situation, right? If you invest there and all of a sudden there's tariffs, you're in trouble. If you invest there and there's no domestic stimulus, you're in trouble. So I would argue that the ability to invest in China is very much going to be based on sentiment and not it's a trade, it's not an investment.
How are you thinking about trying to navigate the future with the threat of tariffs? I mean, the business community in general does not like tariffs. How can you game this out?
Ooh, take advantage of it. I mean, so I one of my things is, everything is an advantageous risk. So the threat of tariffs, advantageous, right? All you have to do is pay attention to what is most advantageous for the administration in terms of tariffs, right? You really don't lose when you threaten and or put tariffs on China. That is hugely popular within the Republican Party and the Democratic Party. Like, nobody is going to fight that. That's just something that everybody's going to clap at and move on. I think it's really interesting when you think about Walmart. So in 2018, Walmart had about 80% of its imports were from China. Beginning of this year, it was somewhere around 60. 2018, India was 0, give or take. Very, very low, like maybe 1%. Now it's 20%. So what has China done? What has Walmart done? Walmart has pivoted from China to India because, one, it's a friendly country that is probably going to continue to be friendly, particularly with the Trump administration. Modi and Trump get along very, very well. I think you don't want to fight the tape, right? And you don't want to fight the Trump tariffs. You want to figure out what's most likely to benefit going forward. And that's pretty much India, a little bit of Japan, probably a little bit of South Korea, and Mexico and US, right?
Yeah.
US, capex, and the grabs. So
There's some studies coming out today,
Yeah.
though, that suggest that Mexico might be among the hardest countries hit by tariffs. You don't buy it?
No, I don't buy it. One, Claudia Sheinbaum, the new president there, already had a call with Trump, and it went really well. That was somewhat of a shock, I think, to me and markets a little bit more broadly. I really think Mexico strikes a deal on immigration and gets very, very favorable treatment on the tariff front, particularly since Trump negotiated USMCA. And if you slap tariffs on top of USMCA, all of a sudden, did you really have that great of a deal? I don't think Trump wants that narrative. I think Trump wants to say, hey, I've got a great deal with USMCA. I don't have to slap tariffs on Mexico. They made a deal on immigration, move on, go. And it's going to catch a lot of people off sides with the narrative of Trump's going to hit them with a whole bunch of tariffs. No, he's going to hit China with a whole bunch of tariffs. And that's going to be much more of a positive than negative for Mexico.
So interesting. And this is why it's so important to not just pay attention to rhetoric, but actually what happens in terms of policy, right? I mean, those can look very different as it works its way through, even if you're in a situation where you have both houses in your favor. I mean, the actual legislative part or, negotiation part it could look very different. That's really interesting. So, you don't worry about this being any kind of weight on the consumer. So even if a Walmart has and other companies have started to divest their supply chains away from China, and let's face it, a lot of this stuff started happening in COVID for other reasons, just for resiliency reasons, not just because of political reasons and fear of tariffs. But there's still a lot of stuff that's sourced in China, even if it's not the end product. There are parts of the supply chain. You don't worry about the higher costs feeding through into what looks like otherwise a very strong economy.
Ooh, so it all depends. So it depends on the cadence. What I would argue is if you get a tariff on various parts and or intermediate goods out of China, but have a tax cut in the U.S., you have call it a supply side hit and a demand side boost. Those would largely offset one another. So do I kind of fret about it? yes, but only because I don't know about the cadence.
Mm.
And if the cadence is done where the consumer has a little bit of extra money in their pocket from a tax cut, but you have a little bit of a tariff and a little bit of an increasing price. Tariffs tend to be a step function in price, right? It's a one-time step function higher in the cost, and then it actually tends to be a little deflationary, but that's beside the point. But it's a one-time step function, and so are tax cuts. So if you offset one step function with another,
right, they're at least equaling each other out.
Yeah, it's a stairway to heaven.
What about, do you expect to see one of the interesting reactions right after the rally? We're still kind of watching it hold its gains, is the big rocket up in the Russell. And there are also some talk about maybe now we see a rotation in some of those names that have underperformed for so long in what appears to be a robust economy, maybe less regulation. It's really going to be small caps time to shine. Are you looking at that as a place for opportunity, especially vis-a-vis like some of the mega cap names that just had sucked all the leadership and all of the energy in the rally previously?
Yeah, so I am a fan of small cap and mid caps here, but quality, right? I'm not chasing the unprofitables. I'm not chasing the biotechs. I think it's really about which of these small and particularly mid cap companies are really well run and set to benefit from a renewed M&A cycle. I think this is the part that's really overlooked. Is the S&P 500 their constituents, they're going to be looking for the next wave of revenue growth, and one of the places to find that is M&A via well-run companies that are under suppressed multiples, right? Small caps and mid caps, they don't have the multiples of large caps. So if a large cap company wants to buy a small cap company and issue a little equity to get that done, that's a multiple accretive. It's a very, very weird world where as soon as you begin to relieve that regulatory overhang, you could potentially see a pretty big boom in mergers and acquisitions, and that's going to be concentrated on the very well-run small and mid-cap companies.
Yeah. And that's it's a place where not a lot of people have expertise. So this may be where you want to lean into people who do follow it, like Sam or some of the more active managers out there. I remember having a conversation with you about rebar when everyone was talking about reshoring and no one was actually talking about rebar. It was amazing.
Yeah. Well, and so it was, I think that was Commercial Metals, CMC, that company. It's still a phenomenally well-run company. It's still doing very, very well. And there was an interesting comment that they had on their latest conference call, or their latest earnings presentation, where they pointed out that they're the low-cost producer of rebar in Poland, and just kind of left it at that. And if you look at the Trump administration has promised to end the war in Ukraine, that's a lot of rebuilding. And when it comes to rebuilding, a lot of rebar is going to be needed. So we got a pretty big giggle out of that one.
Yeah, amazing observation. It's just great stuff. So I just want to ask you, give me a closing thought. What's going to be really important here as we close out the year? What are you really focused on? Because I know you watch so much. You have your eye on all things U.S. assets, but also, as macro strategists, you're kind of looking across what's going to be really pivotal for you. What are you most interested in seeing develop? Because there are a lot of unknowns out there, and presumably a lot of headline risk, because if we know anything, unless there's a completely different Donald Trump 2.0, a lot of policy is tweeting and in front of the mic. So, the headline swinging from that the first time around was unbelievable. So what do you kind of in that sort of slightly unknown future, what are you going to pay most attention to?
I'm paying most attention to the consumer, honestly. The U.S. consumer in particular, the U.S. consumer has remained undefeated in this cycle against all odds. I think it's going to be a very interesting holiday season. I think the lack of political overhang at the moment is very beneficial to the consumer. The consumer tends to pull back when, for whatever reason, both sides of the aisle going into an election, they tend to pull back, they tend to not spend, then they tend to go ham. So I think this could be, and whether it's celebratory or, shopping with feelings, it tends to be a really interesting dynamic. So I'm really looking at, what does holiday spend look like? What does the U.S. economy fundamentally look like, regardless of the rhetoric that we're hearing and the potential for whatever problems might be out there. I think the U.S. economy can continue to be problematic for the naysayers, and we could be talking this time next year, saying, "Wow, the U.S. economy just grew at 2.5%, 3%. Stock market is at 6,500. And where does it go from here?" And not really have a narrative to crack that.
And that would be incredible, because it's exactly what has been happening, right? At every turn for the last couple of years, the people who've been looking for weakness, looking for recession, looking for a rollover, it hasn't happened. And so it's been pretty painful. So that would be incredible if that was the scenario once more. Sam, so great to catch up with you. I just love our conversations. You're always looking at things that are just not on people's radars. And so we appreciate you putting them on ours.
It's always fun.
Great stuff. You can find Sam's work at Wisdom Tree now. So exciting. Sam, thanks. Come back again soon.
Will do.
All right. Thanks, everybody in the chat. Have a great one. We're going to finish up the week with Mish, and we're going to dig into a little bit what's going on with crypto, because she has a crypto product we haven't talked about a lot, but it has been on fire. So we're going to touch on that, and of course, levels on everything, including commodities, which we didn't get a chance to talk about today. So we'll bring that to you later in the week, and you can catch Michael Howe on Substack and on YouTube. He had a lot of great things to say, so make sure you watch that if you haven't. Thanks, Sam. We'll talk to you again soon. Thanks, everybody.